Yo, what's up, traders? Back with you with another video. So today I decided to give you guys my simple, easy strategy, the easiest way to get payouts, easiest way to pass evals very, very quickly and efficiently. And so I thought I'd share the sauce with y'all, obviously. Make my camera a little bit smaller so y'all can see. Boom, boom, boom. So this is NQ on Tuesday. We're in replay mode, right? So definitely you guys are looking for a way to, you know, make money. Now I'm thinking the way I used to trade, I'm always strategy hopping. I'm always looking for what's the next big thing, what's the easiest way, the quickest way to make money. Da da da. Whole time it's just follow one model, pick one model, follow it, and you're good. And so I picked a very simple model. It's very efficient. I called it my 10 a.m. inverse model. I think it's really effective. It's almost like a forever model. It always, 9 times out of 10, you'll see it nearly every day, and I have nearly a 70 to 80% win rate when it comes to this model. So I definitely want to try it out with you guys as well and show you guys and share the sauce as well. So first things first, obviously, let me make a text box, right? When trading this model, the first thing you need to determine is your daily bias. That is the very first and most important thing you have to determine. Your daily bias. I cannot stress this enough how important this is to have when you're coming into a trading day. A lot of traders, for some odd reason, go into trading and like, you know what? I'm just gonna trade whatever pops up. If you don't have an idea, you're just gonna be swayed by noise and you're gonna be fucked, right? The way I trade is that I'm gonna have a bias if I feel something strongly, so strongly about something, and sometimes I'm like, okay, I'm gonna be cautiously bullish today, or I'm gonna be cautiously bearish. Meaning, my bias is bullish until I'm proven wrong. That's how your biases should be. Your bias is, hey, I see this. This is what I think it should be until I am proven wrong. First thing you need to have is a bias. Let's look at this. My bias is bullish coming into this. Look at all of the information we have here. Just a straight up, barely a retrace. We don't even have a 50% retrace coming here. We have not retraced to the midpoint here. I don't see any reason for us to not be bullish. I am cautiously bullish, however. Why? Because I am anticipating that we're gonna reach some type of level in which maybe we're gonna reverse, or maybe some type of level in which maybe we want to go retrace and pick up some more orders before we continue strongly bullish, right? With all the macros that's going on, I am bullish and nothing is changing about it. What's the next thing you have to do? High time frame imbalances. When I say imbalances, right, it sounds complicated, but it is not. You are just looking for fair value gaps, inverse fair value gaps, and gaps in the market. Quite simple. There's nothing any comp. As long as you know these simple ICT terms, you would understand it. But I'm gonna help you guys mark it out. Let's start with gaps. Gaps in the market, as you can see, simple stuff like this. This right here, new week open gap. Bang. New week open gap. Marked out. Done. It's the first and most obvious gap I see, right? So now I'm like, okay, I gotta watch out for this. Definitely could see price is going to come here and fill this one time, sometime, either this week, next week, and the next month. This gap will be filled. That is how market is. Market always is attracted to gaps. It's like liquidity. They won't leave all these skipped orders. Think about all the orders sitting here that have been sitting here for the longest. These orders from about 25,699 to 25,525. There's so many resting orders here that the market has not picked up. Gaps are very important. When you have opening day gaps as well. I don't drop in the daily because it might fuck it up, but let's check it out as well. This different we open gap. Look, this right here in and of itself is a gap that has not been filled as well. This is a gap here. This is a gap right here. It's a daily opening gap. This is a Thursday to a Friday, has yet to be filled. Gaps are very important. Cool. Now we've got that. We've got the new week opening gap. What's the other thing I marked out? Fair value gaps and inverse fair value gaps. Now, fair value gaps more than inverse fair value gaps, I will say, for high time frame um imbalances. I will say that. I think they're definitely more important than inverse fair value gaps. I like you're gonna see later in the strategy, I like to inverse fair value gaps when they appear, not when they're already there. But you'll understand in a second because eventually inverse fair value gaps to me just, if they've been canceled out, they've been canceled out. So let's go here. Let's look for some. Let's search on the hourly. I like to search on the hourly for my fair value gaps. You can find it anywhere. Boom. We've got the closest one we've got here in relation to us until our trading date is this one right here. We got a 1 hour fair value gap. Mark those out. Sorry, I can't type. Jesus Christ. Mark those out every day. In 1 minute, 1 hour. Boom, boom, boom. In fact, we've got another one right here. We've got one right here. It's literally got one right here. Another 1 hour fair value gap sitting right there as well. What else? We have, and mind you, another key thing is that when you're looking for a fair value gap or an imbalance, let it be unmitigated. The ones you're looking for are the ones that have been unmitigated. Those are very, very important to this. So now, unmitigated fair value gaps. So definitely this wouldn't work. I'd see this, yes, cool. It seems this is just, it's gonna be a fair value gap that just lets me know and strengthens my idea that yes, we are respecting bullish structure, but I'm not looking for price to enter here. If price enters here, there's a lower and lower chance that it's gonna respect this fair value gap the more times it comes back into it, and it's entered it a few times already. So definitely don't want to see that. So we're just gonna focus on these in relation to today. So now let's see. It's 10 a.m. 9:30 has already opened, right? So let's mark out 9:30 open just so we can have it, right? In my opinion, 9:30 open is not as important as 10 a.m. open. That is more important, right? 10 a.m. open is more important. You're gonna see why in a second. So you drop down to the time frame. You drop down out of your time frame. So right. So you're zoomed in. You're zoomed out. Now zoom in. I like to sit in the 5-minute time frame, right? 5 minute tells my story. The high time frame tells the story. 5 minute tells me when to get ready. Intraday as well. So now we've gotten our fair value gaps kind of like, marked out. Now I know, okay, where am I looking price? Sorry, this is not, remember, like I said, this has already been mitigated, so I don't want this. Where do I want price to kind of go to? What am I looking for in terms of price? So 9:30 is already open. We're kind of wicking. We're kind of having, structure. It seems like we're rejecting the upside, right? As well. 9:30 did sweep. We did get to sweep, pre-market highs here. So it was already swept as well. I do expect price to come back down, tap into this fair value gap if we truly want bullish momentum. So 10 a.m. opens, right? Immediately 10 a.m. open, we get a flipping, we get a bullish candle. And now the thing is about this candle, what makes this candle very important is that it is a manipulation. The 10 a.m. candle is always manipulation. It is like, not always, but it is majorly manipulation. 80% of the time manipulation. When it opens, the direction it goes tends to not be the direction that it wants to go. So we have a bullish manipulation, right? It seems like we have a bullish open. It kind of wicks upwards, but it closed lower. We know we're getting confirmed that we might have it to come down lower just to take us up a bit higher. So now I'm starting to see my 8+ chart being built, right? My 8+ trade being built. Look for 10 a.m. open manipulation. Very important to this trade. Lets you know like what's happening, how how it works, what direction the trade might be going. Gives you a better idea, gets you more confident. Great. We get 10 a.m. open instantly. We get a wick, but we're still closing above it. So now I'm like, all right, I'm still waiting for it to hit a PD array. I want it to hit an area in which I'd like. Now you're probably looking here. Oh, there's a 5-minute fair value gap right here. This has already been mitigated. This has been mitigated at 9:45. Now this, possibly could have been a trade. You could have taken a long here. Played a calm 1 to 2 or something like that. But this is too big, and this happened pre-market. I'd rather something fresh that happens during the market. Look for things that happen after open. That's just usually how it's more important. So boom, we finally get that rejection and we close under 10 a.m. We wick into 10 a.m. We touch it and we realize, okay, we don't like it. We're still going to go lower, right? So now it lets me know that, okay, price is going to approach a key point in which I like. Now I'm looking here, right? We have an internal low. We have an internal low, and it's also technically right now this is not only an internal low, but this is currently uh New York's low, New York session low as well. This is the current low that we have right now. So I'm thinking, okay, if we're approaching this, we might take out the liquidity here and might create a new low. I'm already keeping in mind we have a fair value gap that's already been tapped into multiple times. So market may respect it, it may not respect it. Let's see. I want market to come down into this 1 hour for value gap. That's what I'm looking for. So now I'm waiting. We're rejecting up here. We finally make that new low, right? And so I think at this time, ES might have, oh shit, sorry. ES might have made an S&T here actually. It looks like it did. ES made an S&T right here. That's another thing. Look for SMTs. SMTs are very, very, very easy to spot. They just let you know the whole story. As you can see, ES made a higher low. Nasdaq made a lower low. S&T. So it's letting me know, okay, we might be prepping for a reversal. Just be ready, right? So now I'm looking. Made a new low. We're still rejecting. We're creating so many rejection wicks as well. Make another low. We're still going lower. Now we approach the first 1 hour fair value gap that I have marked. Now keep in mind, this is the very first one we have marked. This is the one we're kind of looking into. Now you're thinking, this is where I enter a trade, right? It came close. No. Your entry is not. Do not enter off the fair value gap. That is not your entry. You do not just enter when you see it tap the fair value gap. In fact, it didn't even tap the fair value gap. And you're going to see what happens next as well. If you had tried to take this long, get wicked out, you get wicked out, right? You could have gotten lucky, right? But if you were a good trader, right, I'd expect you to be targeting, let's say you did take this long, right? Let's say it did wick and then it closes up here. I'd expect you to target these highs, like proper liquidity. And look what happens. Rejects. So, not a good trade. Clearly, not an A+ trade. Don't like it. It didn't even tap into the fair value gap. It didn't even actually tap. It literally avoided it. So this, in fact, is even better. You know what this tells me? We're getting stacked liquidity. We're stacking up our liquidity here. This is stacked liquidity, right? Look for liquidity. Look for liquidity. Look for where you want price to go. Liquidity is price's magnet. The market always jumps to liquidity. It always wants to grab it. Look for liquidity points, highs, previous day highs, previous day lows, data highs, intraday highs and lows as well, and then the gaps as well are liquidity. We're stacking liquidity on top of a fair value gap that we have not entered. So I've been thinking, and we're still not fully closing above this line, this 930 open. So I'm still like, pretty confident. Boom. Not only did we sweep this low has now finally been mitigated. We also tapped into the 1 hour for value gap. So now, once we do that, scale down, right? Now this seems like a lot of steps. I will definitely condense it at the end of the video. But now, what do? Scale down. I like to scale from 5 to the 3 first before anything. Now I'm looking for opportunity. This is the 3-minute. I am looking for fair value gaps on the 3-minute that have been inversed if I don't see it on the 5-minute. This is the first bearish fair value gap that I see, right? It was a fair value gap up until this point, right? Let me make sure you guys can see this very clearly. That is the fair value gap. Instantly tapped into the fair value gap, into the 1 hour, and we created a bearish 3-minute fair value gap. So let me know if we are truly reversing and respecting this. I want to see this fair value gap become inversed. I want to see an inverse of fair value gap, right? So the next step is inverse fair value gap. Boom. Instantly, it's inverse. It's flipped. Essentially, an inverse fair value gap is just a fair value gap that's just been violated, completely displaced right through. And so this is a perfect example. We get a bullish candle that goes right through a bearish value gap. So now I'm looking, okay, this definitely is a good setup. I am getting ready to take my setup. I drop down to the 1 minute. 1 minute is my execution. Why did I drop down to the 1 minute? Because I want to trade the re-entry into the fair value gap, into the inverse fair value gap. 1 minute retracement entry. You always, if you want to keep this an A plus setup, look for the retracement. The retracement keeps it an A plus. Yes, you could have entered aggressively as soon as this was created, right? But then your stop would have had to be like right here, this low. And then you would have had to gone for crazy R, which probably could have worked sometimes, but it drops your win rate. As I have backtested, it drops your win rate to about a 60 to a 50%. We want higher win rates. We want better quality setups. That's all I want to provide for you guys. So you look for the retracement. So boom, we find the retracement. Now I'm looking for price to respect the imbalance that we have now violated and bounce out of it. And this is all happening on the 1 minute. I see a little displacement. This is my entry. Definitely, if you are a more, a more conservative trader, you can wait for us to take this high, as you can see, right? You definitely could have waited, right, to take the high before we take it. So let's be conservative. Why not? This is still being respected all on the 3 minute, by the way. This is still the 3 minute candle, has not closed under it. But I'm on the 1 minute. Displacement. This is what I'm looking for. A displacement candle. Definitely, this is what jumps your win rate. Makes your win rate from a 60% to a 70%. If I had entered right here, 60% win rate. Entering right here after seeing a displacement out of the fair value gap on the 1 minute, a proper displacement, good enough volume. We took out the last candle high, which is a CISD right here. Then this is your entry. This is your go time. You wait for this candle closure. Keep your stop. It doesn't have to be tight, but let's say I put my stop here at the low. Now I want to target liquidity points. It's liquidity here you can target. But I'm extremely bullish. My biggest target is the highs we made in the morning. That is what I want to target. And so price jugs around until hits TP. Literally just like that. Retracement, wait for candle closure, target the next point of liquidity. This is why you look for liquidity. This is currently New York AM session high. So I'm like, okay, I am bullish. I expect us to make new highs. We made a new low. We respected it 1 hour fair value gap. When high time frame imbalances are huge, they're important. They work all the time. They work nearly all the time. When you want the bigger picture, look on the 1 hour, the 4 hour, the daily. They always tell you the story, right? We got that. We had the invalidation. We were able to take the long, and we were able to take New York highs. This happened around 11 something a.m. I try to look for these trades before 11, but you can still find this trade as long, before lunchtime or trade it through lunchtime, as it did. It traded through lunchtime, closed like right through the halfway mark of lunchtime. And that's the strategy. Very simple, very easy. Find your daily bias. Look for higher time frame imbalances, right? You jump to a lower time frame. I don't have to put that as a step. You guys should know that. Drop to a different time, lower time frame. Look for 10 a.m. open manipulation as well as liquidity points. That's what you want. You want liquidity points. So you want the new ones made and you want the old ones that were there. Do not enter off the fair value gap. This right here is not even a. This is not even a. Whatchamacallit. This is not even a step. This is a rule. Do not enter directly off the fair value gap. Right? Like I said, look for liquidity, which we've already done in the previous step. Now we're down to 5 steps. Scale down, you already know that, but I'm going to keep this here for you guys that don't know. Scale down to a time frame, zoom in, essentially. Look for an inverse fair value gap. You want a fair value gap that's violated. Violated fair value gap in direction of trade. So you want to take a trade to a long, you want a fair value gap that is bearish to be violated and turned bullish if you want to take a long. That is what you're looking for. And then lastly, wait on the 1 minute for a 1 minute retracement entry and displacement. So I'm gonna say displacement so you guys know. Displacement. Sorry, I can't type. You guys are gonna get used to that as well. 1 minute displacement entry. 6 steps. Very simple. Find your daily buy list. Look for imbalances, gaps in the market, fair value gaps. Look for 10 a.m. open manipulation. Kind of wait. You wait for that. It makes it 10 times easier. Look for liquidity now after 10 a.m. What are the new liquidity points? What are the new highs of the session, new lows? What are the previous day highs, previous day lows? Scale down, zoom in. Look for inverse fair value gap, essentially a fair value gap that has been violated in direction of the trade you want to take. 1 minute retracement and displacement entry. You want to see on the 1 minute, it retraces into the fair value gap. It respects the fair value gap on the time frame and whatever the fair value gap is created. But you want to see on the 1 minute that there is displacement, and then boom, you take your trade. And just like that, that's the simple strategy that can make you thousands of dollars as long as you stick to this one model and don't hop around and change strategies. If you stick to this model, I promise you, you're going to make money. You are going to make money. The setup appears every day. It appears every day, and it is at its highest point from 9 to 11:30 a.m. It is at its highest point of win rate. Trade, you're on the charts for 30 minutes. You look for the trade. You don't see the trade, you get off before lunchtime. Call it a day. I placed this trade. I literally stood up. I went to go watch One Piece. I literally entered drawdown for a second and went to TP. And I didn't have to worry about stops. I didn't have to worry about anything like that. Remember, stick to this one model. Don't just hop around. Don't change models. Don't just see, oh, I lost today, so I'm going to pick a different strategy. You lost today to fit the statistic. It is a 70 to 80% win rate, meaning that out of 10 times, 8 times this works. That means you need those 2 losses to validate. You need those 3 losses if it's 70% win rate. You need those 3 losses to validate that this is a good model. Stick to the model and trade it every day. Do not change it. Do not hop around. Do not look for another opportunity. Hope you guys enjoyed it. Stick to the strategy. Manage your risk perfectly. You guys are going to make money as well. I'll see you in the next one.